There is a widely celebrated narrative in modern entrepreneurship that glorifies the lone wolf founder, the relentless visionary who builds an empire entirely from scratch with zero outside investment. We are conditioned to view this path as the ultimate badge of honor, a testament to grit and uncompromising independence. But relying solely on your own limited resources is not always the best strategy for aggressive wealth creation. This self-funded approach, universally known as bootstrapping, is often championed as the absolute pinnacle of financial control. You retain total ownership, you answer to no one, and you dictate every single move the business makes. However, in today's hyper-competitive and rapidly evolving markets, this rigid commitment to total independence can quickly transform from a badge of honor into a massive invisible anchor dragging down your potential. We need to dismantle the ego-driven pride that often dictates these early business decisions. When you stubbornly refuse outside capital simply to keep absolute ownership, you are making an emotional choice, not a strategic one. The desire to survive without any external interference might feel empowering in the short term, but it blinds you to the sheer velocity required to actually dominate a modern industry. In the earliest stages of a venture, operating lean makes perfect sense because you are still proving your concept and finding product market fit. You keep overhead low. You reinvest every dollar of early revenue and you force yourself to be ruthlessly efficient. That initial discipline forged in early ventures creates a solid foundation, teaching you how to maximize limited resources and extract value from every single operational decision. But eventually, that exact same discipline becomes a liability, leading directly into what we call the growth trap. Your company becomes profitable enough to survive paying the bills and keeping the lights on, but it remains far too small to actually command the industry. You find yourself stuck in a frustrating plateau, lacking the financial firepower required to scale operations, launch new product lines, or aggressively acquire new customers. This is precisely where we must reframe our understanding of venture capital and external funding. Bringing in outside investors is not about surrendering your dream or admitting defeat. It is about recognizing when a strategic injection of cash is the necessary fuel for exponential expansion. It is a calculated lever that ambitious founders pull when they realize that organic revenue alone will never generate the momentum required to win. To leverage this tool effectively, you must master the concept of equity dilution, which simply means issuing new shares to investors, thereby reducing your overall percentage of ownership. For many founders, this feels like giving away their hard-earned creation, triggering intense anxiety and resistance. But intelligent wealth builders understand that dilution is not a penalty. It is an active trade, swapping a fraction of control for a massive acceleration in capability. While you are carefully rationing your organic profits to fund a slow, steady expansion, your competitors are playing an entirely different game. Armed with millions in venture capital, they are not waiting for end-of-year profits to hire elite talent, launch massive marketing campaigns, or develop superior technology. They are operating at a deliberate loss in the short term, specifically to capture market share at a speed you simply cannot match. The brutal reality of modern business is that the best product does not always win. The fastest and most aggressively distributed product often takes the crown. When you refuse to arm yourself with equivalent financial resources, you risk being completely overshadowed by faster-moving rivals who understand the power of capital. Your perfectly crafted, self-funded business can easily be crushed by a well-funded competitor who simply outspent you to acquire the customer base. The true strategic challenge we face is not about stubbornly avoiding debt or categorically rejecting investors to maintain a false sense of purity. It is about developing the financial intelligence to understand exactly when giving up a piece of the company is the mandatory cost of winning the market. You have to pivot from a mindset of absolute preservation to a mindset of aggressive, calculated expansion. We see this dynamic play out constantly across high-growth sectors like technology, logistics, and consumer goods, where scale dictates survival. In these arenas, early dominance creates a network effect, establishing a moat that latecomers simply cannot cross, regardless of how innovative their underlying product might be. The companies that ultimately secure these dominant positions almost universally leverage external funding to build their infrastructure before the window of opportunity slams shut. According to research from the Harvard Business Review, venture-backed companies significantly outpace their bootstrapped peers in both speed to market and overall market share capture. The data clearly shows that while self-funding might increase the probability of early survival, it drastically reduces the probability of achieving industry-defining scale. The numbers simply do not support the romanticized narrative of the unfunded underdog, consistently beating the well-capitalized giant. To build profound wealth, You must evolve past the survival mindset and embrace a domination mindset. This requires shedding the limiting belief that asking for money is a sign of weakness and instead recognizing it as a sophisticated maneuver executed by elite operators. You're no longer just a scrappy entrepreneur trying to make payroll. You are a capital allocator tasked with maximizing the enterprise value of your organization. This means you have to objectively evaluate your specific business model and its inherent need for speed versus your personal desire for control. If you're building a lifestyle business meant to generate a comfortable, steady income, maintaining total ownership might be the correct path. But if your ambition is to disrupt an industry, build a scalable platform, or achieve a massive exit, capital is the indispensable weapon you must wield. Attempting to build a massive enterprise entirely on your own back also introduces severe psychological and operational risks, most notably extreme founder burnout. When you're constrained by cash flow, you're forced to wear every single hat, managing product development, sales, human resources, and customer support simultaneously. This relentless grind not only deteriorates your physical and mental bandwidth, but it fundamentally prevents you from focusing on high-level strategic growth. A strategic capital injection immediately changes this dynamic, allowing you to buy back your time and deploy it where it actually generates compounding returns. You can finally afford to hire specialized executives, build robust operational infrastructure, and automate the daily friction that previously drained your energy. You transition from being the primary bottleneck of your organization to becoming the visionary architect directing its forward momentum. This brings us to the ultimate mathematical truth of aggressive wealth creation, which revolves entirely around expanding the size of the total pie. Owning 100% of a business valued at $1 million leaves you with exactly $1 million in paper wealth. But owning just 20% of a business valued at $100 million yields a net worth of $20 million, fundamentally changing your financial trajectory. That is the power of the multiplier effect when strategic capital is deployed correctly by an ambitious leadership team. The initial sacrifice of equity dilution is completely overshadowed by the exponential increase in the underlying asset's total valuation. You're trading a large fraction of a small vulnerable entity for a smaller fraction of a massive, highly resilient, and incredibly lucrative market leader. We have to completely shed the romanticized cinematic view of the struggling founder who succeeds against all odds without any resources. Real financial strategy is not a movie script. It is a cold, calculated assessment of probabilities, leverage, and market dynamics. Pride has absolutely no place on a balance sheet, and your ego should never be allowed to dictate your capital allocation strategy. A comprehensive study from Stanford University indicates that the vast majority of companies achieving hyper-growth status and billion-dollar valuations relied heavily on external funding frameworks. The consensus among financial experts is that while bootstrapping teaches invaluable operational discipline, it is rarely the vehicle that drives unprecedented generational wealth creation. The outliers who do achieve massive scale without funding are exactly that. Statistical anomalies, not a replicable blueprint for success. The real art lies in timing your capital raise to maximize your valuation while minimizing the required equity dilution. You want to leverage your initial self-funded momentum to prove the concept and generate early revenue, creating undeniable leverage when you finally sit down at the negotiating table. You raise money not when you're desperate for survival, but when you have a proven machine that simply needs more fuel to accelerate. Understanding this dynamic empowers you to make strategic choices based on ambition and data rather than fear and a false sense of pride. You're no longer intimidated by the prospect of bringing on partners or navigating term sheets because you recognize them as standard instruments of high-level business building. This shift in perspective transforms you from a cautious operator into a formidable market contender ready to scale aggressively. Ultimately, your financial journey is defined by the scale of the problems you solve and the velocity at which you solve them. Bootstrapping will always have its place as a foundational training ground, but it must never become a permanent prison that stifles your ultimate potential. Embrace the leverage of capital, accept the strategic trade-offs, and focus relentlessly on building an industry-defining empire rather than just a profitable little island.